first, and if you want second, and if you want gender pronouns.
Marius first, Samuel second, no gender pronouns. We both consent to being strange.
Okay, 1 second. Opening opposition. Opening opposition.
Katarina speaking first, she or they, please.
Who's second?
Ilya speaking second, he or they, please.
Okay. Closing government.
Rami will be speaking first, Tomer speaking second, he or they for both of us, please.
Okay. And closing opposition.
Georgia speaking first, she please.
And Adam speaking second, he or they please.
Okay, just reminders that I will be timing you, but you won't hear any dings just because it is preferable that we'll all be on mute other than the speaker because it interrupts the flow of the speech quite hardly on Zoom. So please self-time as well so you can monitor. If you reach 7:15, I'm just going to raise my hands and stop writing. So just bear in mind that this is how it's going to look like. If you're really going to go overboard, I am going to just jump in and interrupt the speech itself, but that's way past that. So also a reminder to use the chat for POIs or the screen, but do not interrupt the speaker's flow. Again, this is quite hard to do on Zoom. So without any further ado, in order to open the debate for side proposition, the House calls upon the Prime Minister. Hear, hear.
Our case in opening government is very simple. We're going to argue that interest rates are a tool to control the economy. If the economy is doing well, you should have high interest rates so that if it's doing worse, if you have a recession, you can lower the interest rates to prop up the economy again. This is our main argument, and we will argue why this is better preserved on our side of the House. Before that, a little bit of a setup to this debate. So first thing is that low interest rates in general are a stimulus into the economy. So central banks can use it to make lending easier because private banks or bigger banks can then just loan the money at a low rate from the central bank and give that money away for a slight profit to individual businesses. So that means that individual businesses have it easier to get money. In 2008, after the recession, initially what most of the central banks did was the good thing. They lowered the interest rate from something like 2% before to nearly 0% now. And it was initially a good idea. But after the economy has been propped up again 2 or 3 years later, they didn't return to back to normal and didn't increase it back up. And we think this is exactly where the problem is happening, and that is what we regret. So we think the counterfactual in this debate is that governments would have just 2 or 3 years after this, after 2008, have returned to the normal when the economy was back up again. The reasons for this are dubious, but we have to, I think it's fair to assume that this is something that we're allowed to defend. Also, just one more quick characterization. Central banks in general set the interest rates for this. The bank loans the money, and therefore the interest rates that the central banks give is sort of a lower bound because all of the players in between want to make a profit. Therefore, whatever the central bank controls is something that is seen as a good indicator for the rest of the population. Okay, now main case. We think that interest rates are a tool to control the economy. If you have a recession, you want to lower the interest rates so that the businesses do not die out, so that they can easy and quickly get money, so that they don't have to leave all of their people and staff. Where if you're back to normal in an economy, you want to increase the interest rates again so that you are prepared to have a cushion for bad times. And this tool is completely gone if you keep them low all the time. We think the comparative within this debate is that we are allowed to have this tool on our side of the House. Opposition in general is allowed to argue that the economic growth over the time from 2011 to now has been larger, and this is probably their main case. We will argue why it is more important to have this tool rather than having a slightly higher economic growth on their side of the House. 3 reasons for this. First reason is that we think downturns are way, way, way harder if this tool is not available. in an economic downturn, in a recession, banks are reluctant to give out loans because there is an economic downturn. That means every risk or every money that you give out has the additional risk because it's in an economic downturn. Uncertainty is high, and therefore banks are reluctant to do that. That means more businesses are unable to get the money, and therefore they have to fire people. And because there is such a large economic dependence, that means that if one company has to fire people, others don't have the cushion to just wait out the recession. They also have to fire people, and then it goes down the whole production chain within an economy. If you have this tool, you stop the self-fulfilling prophecy from happening, because you sort of stop the first stone from falling. You essentially give money to the first large company on a cheaper loan, and therefore they're able to save themselves, and therefore you don't have the self-reinforcing cycle. That can be the difference between an economic downturn of 10% or 30% with respect to GDP of an individual country or their stock value, whatever proxy you want to use. But this is hugely important because it means if you have this tool, downturns will just be way harder. And negative interest rates will obviously never work for if opposition wants to argue this, because you always have this kind of middleman. You still have the bank wants to make a profit. They will never give out negative interest rates in the first place. Only central banks will give out negative, if at all. Second reason for why our side is more important is that the most vulnerable are hit the hardest by an economic downturn, especially if this economic downturn is large, because they're the first to lose the jobs. They're often working in in the service sector, like cleaning, or maybe they work as waiters in restaurants, and all of this stuff. All of these are not super necessary, and therefore the first costs to be cut. They are also the people who have the least money in the bank. That means if they don't have the money, they're more likely to be evicted in a crisis. They have to leave their home. They can't pay the rent. They can't pay education for their children. And once you're out of your home, it's way harder for you to find a job again. All of this is just something that hits the most vulnerable the hardest. Where on their side of the house, most of the benefits of like some sort of economic growth over time is something that benefits, first of all, the most rich in society, because they are the first ones to get, these are the ones who most directly profit from the economic growth, because they're the first ones to control who gets the money. Please see, oh, yes.
I'm very confused. The bank lowered interest rates as a tool to encourage spending. So what exactly are you standing behind?
No, we already argued. We are saying that we would have preferred that the interest rate would have gone back up after 2008 as soon as the economy has gone back to normal, so that we have this tool available. You on your side of the house do not have this tool available because your interest rate has been low all the time. Therefore, you cannot go lower because of the negative interest, because negative interest rates don't work. Therefore, you don't have this tool, we have this tool. Last argument in our case is that governments in general are badly prepared for a recession, like we have seen with the pandemic, for two reasons. Number one, it's a fundamental human problem that we underestimate tail risks, because for most people, large recessions are happen to them the first time in their life. Before that, they might have read it in books, but they have never experienced. So they underestimate the risk of this happening. Also, if you have something like the Spanish flu or COVID-19, this happens 100 years, and therefore you always have this hope in the back of your head that it will never really happen in your life because the probability isn't too large or you haven't experienced it. Therefore, fundamentally, people underestimate it. They don't spend enough in risk prevention and stuff like this. But also, prevention in governments is not sufficiently rewarded in democracies, because it's just not a sexy thing to say, well, I have given a lot of money to the CDC or to something like this in the USA, because it is something that sounds unsexy. It sounds way better to say, I cut something from maybe the CDC like Trump did. Therefore, governments are badly prepared for recessions, and overall, this is a reason why we should have this tool available.
We thank the Prime Minister. In order to open the case for side opposition, we call upon the leader of the opposition. Here.
Am I audible? Just 1 second, please. Just to set my timer. Okay. I'm starting now. Okay, a side of opposition has to defend status quo. Why status quo is good and better than the alternative, and government, what they need to prove is to give us analysis why would status quo be significantly better if we didn't use this tool. They are not like giving some bubble benefits, just they have to clear harms. They have to give us clear harms why it will be better if we didn't use this. Okay, first of all, how does this work? If a central bank gives lower interest rates, we say that central bank, when it sets lower interest rates, it sets them for borrowing to commercial banks that then buy to third like party customers. We say that it is good tool, like in order for them, if this comes from CG, I want to explain this this mechanism. Like those commercial banks are profit driven, meaning they like want to have their money returned. They that means that they will have a lot of background checks. If you want to as a company borrow a lot of money, then you will probably have to like show them some plan, a business plan, in order for you to succeed. Also, we say that after the crisis of 2008, like a lot of states, a lot of banks introduced significantly larger regulation in order to like avoid the reckless loaning and what happened then. Okay, we say also that a central bank will control the amount that is given. This wasn't like the infinite amount of money that was given, just like enough that central bank determined how much it needed to go into economy. We say this is the only mechanism that made like the economy recover and left smaller consequences on it, and I will explain to you how in a second. Okay. First of all, if we talk about large companies, they because low interest rates were so low, they had incentive to loan money, meaning they had money to develop, to not fire workers right away, as it is happening. Like for example, it crisis now, it is really something that usually happens in recession, because they want to cut workers. Especially, we agree on OG on this one. They want to cut like workers that are not so necessary, like those workers on lower skill job. We say that also they are able to pay their costs to investors and shareholders. What this brings, if we have like those money investing more and those companies functioning, we have the fate of employees. Like they do not, if they see their company growing, they don't fear to be fired, meaning they will be incentivized to spend less, spend more. And that is what happened like after this crisis. Like people that didn't fear they will lose their job started spending more, because they didn't feel like they will end up fired tomorrow. We say that also in those like large recessions, companies needed like some money to shift their practices, to like adjust to new situation in the market, and we say that is good thing. Also, we say that those loans are better solution than bailout that would have happened if we didn't have this. Why is that so? Because first of all, government can bail out you infinitely, meaning that usually bailout is some large cost for the government, and it is done in the last moment when there is no other alternative, when like companies deep down in problems, and we say that is bad thing, and we give a larger chance for company to recover. Also, we say that for small businesses, like this give incentive to some people to start small businesses, to develop them, to like which was good to people, because they was for customers, because they had like more chances to because it had a lot of different options to choose from, like a lot of different how to say, like adjusted companies to their needs, and this was better for them as spenders. Okay, so I say on a personal level, we say that large scale spendings are the crucial for those individuals, not for companies, but for individuals that don't feel they will be fired, that have an access to like cheap loans, they are more likely to spend money on more expensive goods, such as cars, such as housing, and not like to stay in their old car because they fear to be fired, fear they wouldn't be able to repay that loan. We say that some key industries would basically collapse if we stop this large-scale spending on personal level. And also we say that people, when they don't have the faith in the economy, they have the tendency to save and not spend money, which means there is no a lot of money fluctuation, and I will get to impacts of that right now. Okay, so what are the impacts of our case? First, we say we have more secure businesses, more able to sustain themselves, more able to grow, more able to keep their employees. We get that on our side of the phone just by introducing, my partner will take you, just by introducing those cheap loans. Second, we have the growth in small businesses that were crucial, especially for some underdeveloped regions. Second, third, we said we have large flow of money, large fluctuation of money, which is extremely important, like for people to spend less on some goods, like that will signal to market to produce more. This is implicitly like boosting economy. Fourth, we have faith of consumers, meaning that they are more willing to spend they and believe, and we need to like emphasize that this is the only tool to stop recession. Like for average consumer to have a faith that that he can spend, that he doesn't have to save a lot of money, but willing to spend on some non-necessary goods. Also, we have five reasons we got more diversified market and more chance for companies to adjust. Sixth impact, we had a larger chance to economy recovery. We said that with our low interest rates, we got smaller unemployment, less businesses that failed, and also less government's debt that would have happened for bailouts and unemployment benefits. For all those reasons, please oppose. Thank you.
We thank the leader of the opposition. In order to continue the government case, we call upon the Deputy Prime Minister. Hear, hear.
Am I audible? Wonderful. 1 second, please.
Well, actually, a little bit cut off. Can you try to speak again to make sure that it's streaming well?
Now, test.
Yeah, if you can just please speak closer to the mic.
Oh, okay. Yeah, I'll try to hold it close to my mouth. Is that better?
Yes, it is. Thank you.
Okay, great. Okay, we'll start in 3, 2, 1. Let's go. Panel, we've just listened to opening opposition tell us for 7 minutes that cheap loans which induce economic growth are a good thing. We broadly agree with the fact that cheap loans stimulate the economy, and stimulating the economy is helpful. However, our case is not that this is generally bad, but it should be used specifically after economic recessions to prevent a runaway negative flywheel effects, and because economic growth is more valuable when the economy itself is struggling rather than when it is already naturally strong. The important comparative that they never engage with is that if you continuously keep interest rates low and you hit a new recession, as is incredibly likely, and I'll give some more reasons for why that's the case, then you won't have the ability to further lower interest rates to stimulate the economy again. Like, interest rates have been very close to zero ever since 2008, and oftentimes been even lowered after, like, the economy of Europe and the US has largely recovered to pre-crisis levels or even gone far beyond. We think this is a crucial misstep because it leaves us vulnerable and underprepared for future crises. Okay, let's quickly talk about why a new crisis is very likely to come at some point and why we need to have some leeway in terms of lowering interest rates to be able to prevent the negative effects effects of this crisis. So A, what we're going to tell you is that if historically speaking, the world economy has just naturally been cyclical, aka like we have boom cycles where the economy grows quickly in a lot of places, and then at some point we see that our expectations of economic growth have been like overconfident, and you have some corrections again, as happens in the stock market a lot of times actually. So it's A, an historical trend. B, the current stock markets, both like in the US and Europe, are incredibly optimistic about long-term growth, and the prices of the stocks can only be justified if you look at absurd stocks like Tesla, if you assume continuous perpetual growth. However, this is incredibly unlikely because we can see that most mature economies slow down their growth after reaching certain like growth plateaus, and this is like a proposition that is quite unlikely. So we think at some point there will be stock market corrections around this. Thirdly, historically there just have been like different forms of financial, economic and stock market bubbles in a lot of different ways, and these are always hard to foresee. That's like the mere definition of a bubble, that you don't see it coming. But this has happened quite consistently every 30 or 50 years. This has happened in 2000, it has happened in 2008, but it's also happened in the 1930s and the 1980s and the 1960s. There's simply a large track record of this. Lastly, there's just so many external shocks, corona, climate change, all of these things could induce a crisis. So we think it's likely. And this crisis is going to be even worse than past crises, because ever since 2008, the world economy has become incredibly tightly connected. So if there is a crisis in the US or in Europe, it will have ripple effects into China and into much of the developing world. As a result, countries that are way, way less prepared to even do anything about a crisis will now also have to weather the effects. So the next crisis will be coming, and it will be global. And this is why we need to be prepared. Okay, cool. So why is our other possible alternatives not functional for opposition sides? So I think like either they can not have any mechanisms of combating the crisis, which is bad, or B, and Mary has already explained to you, if you don't do anything about a crisis, then a lot of different businesses have incentives to scale back their operations. And if one business scales back their operations, all the other businesses need to respond and also scale back their operation. And this induces a negative feedback loop, which then hurts the economy overall. This is the feedback loop you need to stop. This is why you need economic stimulus. What other options do you have? Either you do it through the central bank with fiscal policy, or you do it with monetary policy, or you do it through state spending with fiscal policy, with just governments pumping money into the economy. Why is that a worse option and generally not reliable? Because A, state spending is politically hard and slow. Two reasons. A, like deficit spending, so like states taking on debt to spend money is usually something that's controversial, because to the average voter who hasn't studied macroeconomics, it seems like an unwise thing to do and long-term detrimental to a state. So a lot of voters are not naturally on board with this, and especially not with like trillion-dollar bailout packages. Secondly, conservative politicians who are strong in a lot of countries have a natural ideological incline to be against deficit spending, because it's one of the important like messages of most conservative politicians to like balance the budget. Okay, but we say even if it happens, and we've told you that it's like comparatively less likely that it happens, it is something that will like take longer to implement, and as a result have far less effects, because the negative feedback cycles have already taken place at that point. Why is that the case? A, it takes more time to be decided. So like a fiscal stimulus package needs to move through the House, it needs to move through the Congress, and be approved by the president. At every stage here, there's a lot of different things that delay it, and negotiations. That means it will take several weeks to months until this can be implemented after an economic crisis has happened. But secondly, state spending is just difficult to coordinate and hard to do. So if you try to like spend $1 trillion quickly, that's a really hard thing to do, and that's especially hard to coordinate amongst like several different government ministries, and something that's difficult to do. I'll take CO now if they have one. Okay. No luck. Okay, cool. So then let's talk about why interest rates should actually be high in strong economies, and why we think that on average, like the economic growth gained from having low interest rates is just way higher when your economy is weak. This is because economies just reach a point of natural saturation, at which point further growth is way harder to achieve, and you need more input variables to achieve the same amount of economic growth. Four main reasons for that. A, people's consumption doesn't scale linearly with wealth. The richer I get, the more of my money I'm willing to save and not actually spend on other stuff. So the economic growth that is induced by me having higher wages is lower than if I started at a lower point. Secondly, once you reach semi-full employment, and most people that can reasonably have a job, growing the economy doesn't actually increase a lot of people's welfare, and it is less useful. Thirdly, economic resources are simply constrained. Like, to the extent that most economic resources have been used up, it's harder to achieve additional economic growth by using additional resources. Instead, you need to compete for existing resources, which drives up their price and makes economic competition harder. Lastly, there's just a limited amount of good business ideas. Once they've been realized, finding new ones that are genuinely innovative is hard to do. What does this mean for the debate? It means that, like, artificially induced economic growth through lower interest rates is very valuable in times of economic crisis and low economic performance. It is far less valuable when your economy is already doing well. There is a crisis that's coming. We need to have the tools to prevent it. Opening opposition needs to engage with this actual comparative and explain to us how they plan to stop the crisis and not, like, sink the world economy. Very proud to propose.
We thank the Deputy Prime Minister. In order to conclude the top of the debate, we call upon the Deputy Leader of the Opposition. Hear, hear.
Can everybody hear me?
Yes.
Okay, thanks for the telephone. I'm sorry, just a second. Okay. Okay, I will start now. So first of all, there is a couple of problems with the opening government. The first thing is that what they never explain is why there is a reason. If we have a lower interest rates in the status quo, if a recession happens, what is the reason for us to lower it? If we provide enough money to the economy and if the recession happens, we can still provide that same amount, that amount of money to the people. The interest rate will be still be low, and people will still be able to get their money even in the recession. So they never provide to us why it is necessary for us, if the interest rates are low, why it is necessary for us to lower them even more if the recession happens. Moreover, they ignore that the central banks can even implement negative interest rates. They can even implement negative interest rates. So that means that on our side of the house, we are still getting that mechanisms of lower interest rates, and still people are able to get influx more money. The obvious example for this is Japan, that has interest rates that are below zero, and this is actually possible, and this is actually can be achieved, and this happens in the status quo. There are examples for this. Now, on their other case, first of all, they tell us that there are no other ways to battle the recession, but then they say 3 or 4 more reasons that are mechanisms actually to battle the recession. Okay, the whole crux of their argument is that those other mechanisms take more to implement, and they take longer, and that in the recession you need to act fast, and that these are unvaluable for those types of things. Notice that politicians have the power to implement most of the policies. If there is a rash need for them, they can implement it much faster because it is a time of crisis. This is this is, for the example for this is the Donald Trump gave $2 trillion to the economy. This was implemented really fast because there was a need for this. So this is mitigating really their point about all the political pressures and things that can happen to mitigate this. The second reason is about why higher interest rates are good. First, I don't understand why they can claim that that there are a limited amount of ideas for the businesses. This is completely not true. And if you are one business, there is probably an infinite amount of opportunities for you to grow, an infinite amount of opportunities for you to diversify. There are the needs of the people that are consuming your goods are constantly changing. There are shifts that are happening, and in order for you to get with those shifts, in order for you to grow, you actually need loans. Why is this really important? Because on our side of the house, in the status quo, we are giving them loans at a lower interest rate. We all agree how this happens, and this is the only only mechanism how this happens. So what does this actually mean? This actually means that we are actually benefiting the economy in the status quo actively. We are actually helping all the companies to actually match their needs, to actually match the needs of the people. And we are actually helping them progress. What are the obvious impact of this is that we are bettering the economy of one country. This is the complete benefit on our side of the house. Notice that if the economy is better, if we prove to you that there are many more possibilities for people to actually better the economy is more suited to deal with the crisis. If we are actually regressing the economy, if the economy is not benefiting, this means that if recession happens, and we agree that the recession will happen, this will have a lot more large-scale impacts on the economy. If the economy isn't developed, even if the economy isn't equipped, this means that it will take much bigger impacts than on their side of the house, which is only about time that I mitigated, but only time that is pulling away those things. Now I'm going to explain to you how are lower interest rates actually benefiting the people in the status quo. Notice then what do people use credits? What do people use credits, and what are the things that they are buying? When you as a regular person try to get a credit, this means that you are probably going to buy that car with that credit. You're probably going to use that credit for a new house and things like that. This means that we have some crucial areas that depend on these types of credit, these lower interest rate credits. This means that if we don't have that in the status quo, especially in the time of stable, this means that people are probably not going to buy a new car. They're probably going to stay in their old car, and they're probably not going because of the higher interest rates, because that is actually not profitable. So we are incentivizing people to actually invest in these crucial industries that are actually dependent on these type of credits. I will take the POI, OG.
Yes, okay. The reason why the interest rates have to be lowered during recession and can't just be absolutely low is that you have to send a signal to your economy that they don't lay off workers and spiral the whole recession out of control. This way they can't be absolutely low.
Okay. If that is true, I provided to you a mechanism that we can still lower these interest rates. We can still lower it even below zero. That will actually clearly send a signal to the people that you are actually investing in the economy and that you are actually actively trying to prevent these disasters. So their case probably doesn't have any impacts because of all this frame that I provide to you. Secondly, what is also most important is that what is the most important is how actually companies are going to use these credits. First of all, we are incentivizing banks to give out loans. This means that they have highly procedures for you to even get that loan. So that means that we are allocating money in a good way. This means that we are allocating money towards the companies that are actually have a business plan, that actually have ideas. This is largely also the answer to the OG that is telling us that there is that can never be any progress in the market and things like that. So we are actually allocating money to the companies that are actually have clear plan and actually have clear incentives in order to grow and actually can present those plans. We say that in order for the economy to grow, that these types of money influx is really good, because in order for you to pay your workers, people need to buy your things. This means that you constantly need to appeal to their needs, and you constantly need to grow, and you constantly need to get loans in order for you to grow. Okay, based on all of this, we are glad to oppose.
We thank the Deputy Leader of the Opposition. In order to start the back half of the debate, we call upon the Member of Government. Here.
Second.
Okay, the most important thing in this debate in CG's case is stable economy. We think even if in the short term we have more growth in the economy, we prefer the goal of central banks is to have more stable economy, and I'll explain why in my speech. I have 2 points. One, why we are why the weak people will enter to more debt, and this will harm them in the future. And two, why this harms developing countries. I start 1 point from that. The basic point is if we give low interest, then people will buy more things and the economy will grow. We have two things about that. One, if we have too much low interest, as the motion says, people usually don't prefer to buy. Usually, people prefer to buy things that they can they can sell in the future, not things that that give more work to other people. So, for example, I don't buy a new car or buy from some business. I buy a new house. So because I think this this is easy for me to borrow much money, and when I buy a new house instead of new car, this doesn't create more jobs. So this second battle about the alternative. We think the alternative is that weak companies might have failed if the interest were higher, but strong companies are not likely to have failed because we can we could instead lower taxes, and if we lower taxes, then the strong companies who still earn money will in the long term they will be able to close their debt. But the weak business who don't earn more money they might fail, but only the weak businesses that don't have much workers might have failed. But why this is true? When we have more people, more close businesses fail, this means that the business that earn less would have failed. And we have more workers that can work now in the more efficient business. So now stronger business will see the more supply of workers in the market, and this means they can hire more people easier, and they will have to pay less wages, lower wages, which means they can lower prices. And when they lower prices, then the people will be ready to buy more as once. So this is my first reason about so this is about the alternative. Now I'm starting my point about why people will earn more, will have to enter to more depth. We say that people in their world are less able to have savings, because when we have when we have lower interest, more people will be borrowing money, as they say, and there will be more money in the market, which means more demand on goods, which means the businesses will have to make prices higher, which means more inflation. The same amount of money will buy less after 1 year. What this means that I don't want to save this my money with me, because in 1 year this money will buy less goods after 1 year. So people have less incentive to have savings, and they only send their money to other places. So they buy more stocks, they buy houses, they buy cars, and so on. Why this is bad? This means that if this growth won't continue forever, right? And once the growth won't continue, this means that the value of the price of the value of the house I have is now growing less and less. If the value of the price I have grow less, but I still have the same amount of debt, then I can't close my debt. But why this is likely to be the case that the growth won't continue forever? Because when we have more and more loaning, we have too much supply for the houses, for example. Many people who buy houses, and the house prices won't grow forever, right? So while people have the idea that this is a growth and this is our chance to borrow more and more and build more businesses, they will just borrow more, but they will have huge debt that we don't have to, they can't close in the future. Also, this keeps the weakest businesses alive, because the weakest businesses now have the chance to borrow more and more, and they was just keep them barely alive. They can now close they can now operate, but they have huge debt and they will in the future these weak businesses will close, and we have even more fired worker. Why this is bad? pay attention that the money we take from banks is the money that people give it to banks. If the bank lose money, this means that the businesses the businesses will have also much losses because the business who gave the money to banks are now can't have their money in return. So when people have debts who that they cannot return, this means that insurance prices become more expensive, the pension of the people grows less, and so on. So in the future, the economy will be hurt even more. So now PYO. Okay, my second point about developing countries. Pay attention that although we give the people more money, the amount of goods stayed the same. In the short term, the amount of products we have didn't grow. So when now people have more money, people are likely to buy from the strong factors. So if we talk about developing countries, the people from developing countries are more likely to buy from stronger countries, and developing countries are more likely to borrow from stronger countries because the interest is less. So they go in the only option they have. But this means in the future the developing countries have more and more debt, and also people of the developing countries are more able to migrate to stronger countries because now they can they can take more money and buy goods to their family, and they have easier migration process. Therefore, the developing countries are losing doctors and workers and their people. And now there's not much income left in developing countries, and this means also that companies will leave these countries because they saw that they have so much debt, and they will fear that these countries won't be able to close the debt in the future and will have big national debt. Therefore, companies will also leave developing countries, which make them even weaker.
We thank the member of government. In order to start a case for the closing opposition, we call upon the member of the opposition. Here.
First of all, why OG is framing this debate doesn't stand. Secondly, providing you more mechanisms to how specifically low interest rates are there to encourage more spending and hopefully add more nuanced analysis within the context of the 2008 crisis that helps us take over from our opening. And finally, actually how this helps develop countries that are very reliant on exports. So just keep framing in this debate because OO needs to stand behind the status quo. What is the status quo? The central bank reduced interest rates in the aftermath of the crisis. And these did stay low for some time that OG talks about, but this was only whilst the economy was covering. And bear in mind, this takes a lot of time. We're talking about like fixing a housing market, huge things that take a lot of time to trickle down into the other aspects and have that recovery to begin with. However, since 2015, these interest rates have been gradually increasing again. So I don't think OG are correct to say they've just stayed low since then. Yes, it's been quite a slow gradual increase, but you want to avoid a lot of economic shocks that would come from just suddenly increasing interest rates. They may have since gone down since coronavirus, I'm not too sure. But it's also just important to note that banks have an incentive to always increase interest rates when they can. Why? Because they want to maximize the returns they get on these loans. They're profit driven. Therefore, they're going to want to increase interest rates as soon as they can. And they do want leeway in the future to use it as a tool in the long term. I think OG mischaracterized how smart, intelligent banks are. Central banks know they are vulnerable when they set low interest rates for future crises. Therefore, they have an incentive to raise them as soon as possible when they can. And why they had to be extremely low? Look, I think they were still as high as they could possibly be. However, 2008 was an incredibly severe crisis. There were huge bailouts, huge defaults. They just really needed to be this low when the market confidence was so damaged. And if we show that it increases recovery time for the economy, then we also mitigate lots of the harms that OG bring about how you're more vulnerable in the future, because at least then we can increase these rates again quite quickly. So why is it necessary to decrease? Because I think it's important that the biggest hurdle in the aftermath of any crisis is market confidence. I've talked about why it's important to get people to start spending again, but I don't think they've talked about why people aren't spending in the first place. Because in the wake of the crisis, one, the housing market crashed, so people lost a lot of negative equity in their homes. Two, people lost a lot of savings when everyone tried to take out money at the same time. Three, there was huge companies collapsing. That this stores a huge amount of fear in people, to the point at which they just have a huge urgency to save their money. This causes a massive liquidity problem in the economy where money isn't circulating. Therefore, you have to actively push people to spend their money, to take out loans, and by doing so, making it in their interest. That's why I also just don't think CG's argument really stands within this debate, because most people in the wake of a crisis do not want to take out more loans and do not want to spend any of their money. Therefore, it's only the most desperate people, the most poorest people that perhaps are still taking out these loans. However, crucially now, if you have a lower interest rate, this means they have less chance of defaulting and it's still less expensive for them. So for the people who are most desperate to take out those loans and will do it on both sides of the house, at least now we can offer them cheaper for those poor people, and therefore it is more advantageous. And this also shows that why none of the other mechanisms that OG talk about work, because they talk about bailouts and stimulus packages, and but these are all completely mitigated when people aren't spending. I look at the current state in coronavirus at the moment, where businesses are being given grants and they're being bailed out and given furlough schemes. That's all great in the short term, but unless you encourage people to actually go out and spend their money on these businesses, these are only ever short-term fixes that are never going to lead to more long-term impact. So how do we get people to start spending? I openly have already talked about how it makes loaning more desirable, and also because people don't fear losing their jobs, it's more likely to do so. I hope we're going to provide some new mechanisms that I think give a greatest impact. Because when the central bank reduces their interest rates, this also affects many other interest rates and loans in order to do so. I think there's a crucial one is number one, savings accounts, because this means that interest rates for saving accounts also decrease. People get less return on their savings. This just means that it is just less profitable to save your money, and actually investing and spending in it is just a more profitable option. I think this is a much harder push and harder mechanism than our opening provide that literally gets people to push people to start spending. Also specifically, this actually targets rich people. This is why OG's claim that this only benefits rich people doesn't actually stand, because only rich people are the people that have savings to begin with, and therefore it's those people that are pushed more into spending their money as opposed to just saving onto all their wealth at the expense of everyone else. Secondly, they also lower mortgage rates, crucially, because obviously this makes it the cost, it means that the cost of your mortgage is far less. I think this is also incredibly important within the context of 2008, and especially also Europe as a whole, because Europe is a nation of borrowers. Those people have quite high levels of mortgage debt, and especially within post-2008, that was caused by too many people taking out loans for houses. This means there were a huge amount of debts that people were really struggling to pay back and pay their money on, forcing them to default on their debts, forcing their houses to be put on the market, and hence further perpetuating the cycle. Therefore, if you make mortgage rates specifically a lot lower, this means people are less likely to be able to have to default on their debts, because they're just more likely to be able to pay their mortgage on a monthly basis, and therefore try and mitigate the harms of the housing market completely collapsing. Also increases their disposable income and rises spending, as I openly talked about. Thirdly, also it causes rises in asset pricing, because when you have lower rates and lower interest rates, it makes buying a house seem more attractive and profitable. This therefore leads to a rise in housing prices, because there is more aggregate demand. I think again, within the context of 2008, when the market housing completely crashed and people are literally losing negative equity on their homes, any sort of mechanisms that increases the wealth of their house that back to what it initially was is probably a good thing. I'll take a POI from opening now.
Okay, your assertion that we still needed low interest rates long past 2008. However, the global economy was already larger than pre-2008 levels back in 2014, and interest rates are still below their pre-2008 levels to this day. Your empirics are wrong.
Okay. They are lower than they were before, but as I said, these things take a lot of time to recover, and they have been gradually increasing since 2015, and you have an incentive to do that for all the reasons I said. Finally, then, in this thing on why it helps developing countries, especially because it also leads to the depreciation of the exchange rate. Why? Because when it becomes less attractive to spend your money for all the reasons I just said, it often means within these countries there's less demand for that particular currency. This means that currency falls in its value and becomes depreciated. This therefore means also there's a fall in the exchange rate. For example, the British pound sterling is now less valuable, and compared to the dollar, you get less for it. This crucially therefore means that your exports are far more competitive, because they're far cheaper for other countries from other places buying off it when they use the exchange rate to buy all your products and demands. And therefore increases aggregate demands for a lot of exports. This is particularly good within the context of developing countries. Why? Because a lot of developing countries are reliant on exports to begin with, more so than a lot of imports. They often, their economies are often very focused on agriculture to begin with. They often rely a lot on huge, big developing countries to buy enormous amounts of their exports, things like cocoa beans in Ghana, or I don't know, bananas in maybe Latin America. Therefore, I think for those poorer countries, if you are able to allow them mechanisms to devalue their currency and make their exports far more competitive at a time when other countries probably do not also want to spend a lot of money because they've also had a huge amount of debt. Therefore, you first of all encourage those external countries to keep spending and to keep buying other people's exports so that those economies do not collapse when they rely on exports and makes them more competitive. And again, okay, for all those reasons, proud to propose.
We thank the member of the opposition. In order to conclude the government bench, the House calls upon the government whip. Hear, hear.
Okay, just before I start, to make sure, am I audible? Great, I'm going to start in just 1 second. All right, I'm starting right now. Panel, we think that the main question that needs to be answered in this debate is the question in which world the central bank has more power to keep stability in the global level, which then also turns out to be in a local level. Now, because of how the central banks work and their cooperation with the normal banks. Now, we think that Rami, in his extension, has managed to answer this question better than all of the other teams in this debate, and I will go through them and show you how he does it. So first of all, we have in first half that argues about the lower interest rates. So the government obviously says that lower rates are bad, and the opposition says they're good. Notice how neither have provided a concrete counterfactual as to how this world would look like if we had not had these lower interest rates for such a long amount of time. Now, Rami obviously expands on OG by also presenting more harms about the damage that has been caused by this, because he's saying that people have less saving and there's now more demands on the same goods, and then the same amount of money buys you more goods after a certain amount of time, and then it results in people spending more money on the same amount of goods. But however, notice that Rami also then explains what would be the actual world that we would prefer and how it would look if the interest rates would go back up after a certain amount of time. So obviously we agree with oppositions that they would need to be low at the start of the crisis, but also the entire first half gave a concession that after the crisis has already been stabilized, now is the question of whether or not we should bring them back up. And now what Rami tells you is that if they had gone back up, our situation would be much better, because he tells us that inefficient businesses would collapse. And yes, it is unfortunate that some of the businesses would collapse, but these would be, from his analysis, the businesses that would be the less efficient to the market. So now what happens is it's easier for stronger businesses and more efficient businesses to find employees. And now they can also lower their taxes because of that, because they have less competition. And therefore, we overall get lower prices. So this is what he does in his first point. But notice what OO gives us on this point. They tell us that there's if we have lower interest rates, then we have a better chance and more options to choose from for people in need. So first of all, they never explain to us why this is the most important thing, why this is more important than stable economy for globally, but rather they choose to focus on a small amount of people or a relatively small amount of people who cannot afford to buy cars. And they don't show us why we need to do this specifically right now. Yes, we already agree that we need to do this after the crisis, but if that was the most important thing in the world, then we would have low interest rates forever with no change. And they don't compare us, they don't show us why that would be a good thing to keep for as long as possible. Now, also, they don't. Also, we think that if they care about that so much, then you should actually support higher interest rates because of Rami's case, because then the central banks have more power and more money to give out. And if they do that, that means that the central bank is actually completing its job in the best way possible. And this is exactly what we think the motion is about. And this is why we think that Rami's extension does the best job in fixing the situation that the motion talks about. Because if the central banks have a low interest rate, then they get less money back. If they get less money back, then they cannot do anything to improve the economy. And now here's three extensions that we have in this case above OG, because first of all, this extension it does not depend on some sort of huge economical global crisis happening. They say, yes, it's likely. We say, yes, we kind of agree. But even if it doesn't happen, right, then the central bank still has more power to improve the economy overall, even if there's no crisis. Second extension, all right, Rami explains that if there's a local, I'll take you in a second, if there is a local crisis in a certain place that does not still affect the world, which we think is much more likely to happen than a full-on global crisis, then there again, the central bank has more power to fix that crisis in that certain point, like a developing country, for example, and therefore, we prevent something that could have happened and could have become more global. And third of all, he tells you, and the third extension is that Rami explains that this bank can actually now target problems specifically, and it doesn't have to be about a global crisis. Before I continue on, I would like to take, I'll take CO.
Okay, if businesses are going to take out loans on both sides of the house because they probably don't want to go bankrupt, at least on our side, where it costs them less, they're less likely to default on that loan and less likely to actually go bankrupt in the long term.
Yes, but as Rami explained to you, if all of the businesses in the world continue to exist, even if they're not efficient, then that means that the market is generally in a worse place. Because if we have markets that are inefficient, it means that we have too many options. That means it's bad, because then the good businesses are not able to produce better and more quality products for the society. Now, notice that CO's only attack on our case was that most people don't want to take loans, only the desperate ones. It happens on both sides of the house. Now, our response is, well, this is false, because if we have lower interest rates, then people have more incentive to take more loans when they have less risk, because they can allow themselves to do this. The desperate, yes, they take it on both sides of the house. But if we have more people taking loans, that means the central bank is getting less money back because of the lower interest rate, which means that it now has less power to continue and to solve problems elsewhere in the world. And so, they also tell us that we need the prices to rise, and they have risen. It has taken that amount of time. We have fixed the markets that were in danger of collapsing, but now we need to focus on more important things. For these reasons, we beg you to propose. Thank you.
We thank the Government Whip. In order to conclude the opposition bench and the debate as a whole, we call upon the opposition whip. Here.
Can everyone hear me okay? Just give me 1 moment then. Right, so we're going to go team by team here. We're going to first of all deal with your GK, second of all CEG, finally engage with why we think that we are more valuable than OO in terms of determining op bench's victory here. Okay, First of all, let's talk about OG, right? Because I think that they give us kind of an interesting framing as to this debate. So they immediately concede the extent to which these interest rates are useful to deal with the crisis. Whether or not you buy this is like a thing that they can do in the debate, given that they seem to be arguing against lower interest rates after 2014 or so instead of after 2008. I think that even if you buy that, I think that there are a couple of reasons why we're still going to beat them, even if we accept their framing to be true, right? And I think this is also one of the reasons why we take it over our opening, that we're going to engage with their framing. I think one note that would give you structural reasons as to why it's likely that banks are going to raise interest rates to some extent when they're safe, when it's safe to do so, right? And they want to decrease the vulnerability and again have this tool, as OG says. I think the critical flaw in OG's case, right, is that they never give us the reason as to why banks would keep interest rates low for longer than they have to do so. I think the issue with this is that we're just left unclear as to why it would be the case that these interest rates will continue to be so low even when they don't have to. I think that's a critical reason why they lose, right? But beyond that, let's talk about this idea of using interest rates as a tool. And CG does some work on this too, looking at specifically in developing countries, why it's useful to have this tool available. There's no point in saving that tool for a crisis and then not using it, right? You only save a tool so that you can then use it in a time of need. I think that we tell you that 2008 was that time of need, right? So I think all we need to do to beat this point is to show you that there were benefits, or like really important benefits, in terms of continuing to use that tool even up to the present day, in terms of dealing with the aftermath of the 2008 crisis, which, by the way, we think is still continuing, and we're going to justify this in a moment, in order to beat this case, right? Like, sure, you could have saved that tool to use later, but then you wouldn't have been able to use this tool now, so you would have had all harms just coming sooner, right? Why do we think that it is that this tool has been really useful, even if we say beyond 2014, right? Why do you think the interest rates have stayed comparatively lower than they were beforehand? I think it's because of this critical framing that Georgia gives you about the massive impact the crisis had, specifically on like long-term investments on other people's psyches, right? And that a lot of what was lost for people's life savings, people's homes, people's cars. I think that these are massive amounts of money that cause a massive change in people's lifestyles, right? That you need to change your lifestyle in order to regain a lot of the finances that you've lost. There's also probably some psychological trauma there, and that you don't want this to happen again. I think that the images of this are burned into people's minds to the point that in order to keep businesses afloat, save equity of homeowners, etc., I think market confidence continues to be so low that you need to keep the interest rates low to keep people willing to do any of these things, right? I think even if you buy OG's framing that like they support this before 2014-ish and then oppose it after 2014, I think it's still necessary for it to be comparatively lower afterwards, so that you're able to maintain this confidence because of how traumatized people are both economically and psychologically. I think that's a framing that we give you. I think that's why we beat them, and also CG's case there. Let's talk about some of the other stuff that CG brings in that's more unique, right? So I think CG tells you a couple of things. First of all, they tell you about how people ending up in debt and companies ending up in debt, and specifically the most vulnerable individuals, mean that they're going to go out of business, etc., or people are going to default on loans. I think first of all, let's characterize the mindset of banks post 2008, right? But the problem in 2008 is that they gave out massive amounts of loans to really risky people and risky businesses, which kind of ended up screwing over everyone, right? I think that if people default on their loans, the banks get no return, so they don't have an incentive to do that. Note that this time they're likely to do better, they're likely to be better, and likely to be more cautious, specifically because they've been screwed over that first time. So I think that people are likely to pay it back, right? Because the credit rate, because they're going to take into account people's credit ratings, etc., which they didn't do to enough of an extent before. Let's talk a bit more about this idea about inefficient businesses, right? Because they note that a lot of these businesses and companies and also individuals that we're talking about are going to need to borrow anyway in the aftermath of a crisis, right? They need to borrow because they've potentially lost some investments, so they need to do so in order to maintain either lifestyles of individuals or activities of businesses, right? So that, if you consider mortgages, etc., in the housing market, people are also forced to maintain these. So you get the point at which a lot of people are just forced to continue borrowing. They don't necessarily have a choice. I think that you're better off having the lower interest rates, so that means that people are going to be able to pay it back, and they're more likely to be able to pay it back without defaulting, which is what happens if you give out these higher interest rates. Why specifically is these people that we're talking about is because generally we characterize the market confidence as so low after the massive extent of this crisis, specifically about the long-term investments, that a lot of people who didn't need to borrow and businesses that didn't need to borrow were unlikely to anyway, right? Even with the lower interest rates, I think Georgia can see these reasons why people are really, really cautious. And I think what we tell you is that you need to have those lower interest rates, not to encourage everyone to borrow absolutely everything, because we just don't think that that's what happens, because people were cautious of doing so anyway and engaging with the banks. It meant that the people who did need to do so were able to do so. They were able to do so to such a way that they could pay those loans back and sort of accrue the benefits of doing that. let's talk then about this idea that we get about developing countries specifically. I think one, the same analysis that we already gave you applies, that they are always borrowing anyway, and this means that they're able to do so and then pay that back, whereas if you had higher interest rates, they wouldn't be able to do so. Second of all, I think Georgia gives you the critical analysis about how you increase demand for exports, because they have a mechanism that they can use to devalue their currency, which is particularly good for primary sector economies that depend on like agriculture, and then export that to the rest of the world, which are likely to be developing countries anyway. We don't get any response to this from CG, so we think we beat them on their own developing countries clash. Let's talk about OO then. I think there are three main reasons why we beat our opening half of this. I think one, that we engage with the debate that OG sets out, right? Like, sure, OG sets out kind of a bizarre debate here, but still something that probably needs to be responded to for the sake of the debate. And I think we engage with that when we tell you that even if the market seems to have recovered by 2014, I think that the recovery can only continue to be a thing and investment only continues to happen at the point where we have such low interest rates because of the massive long-term impacts it's had both on people's finances and like ability to invest, and also their psyche and their willingness to invest. I think both ability and willingness we take there. Second of all, I think we tell you specifically in the context of 2008 and the housing crisis and these long-term investments, why it has to be interest rates that we're talking about. And thirdly, I think we expand the debate quite significantly at the point where we talk to you about specifically developing countries, right? I think that this is really important because these countries, as CG themselves identify, and this is part of the closing half clash here, are at the most amount of risk, right? In that their alternatives, such as taking out loans from the World Bank, often have really limiting austerity measures, and that they are told that if they want to take out these loans, they lose the ability to like govern their own finances and govern their own financial policy. I think at this point it's particularly important that these countries have access to lower interest loans and loans that they can get more accessibly, because it means they're better able to grow their economies both in the short term, recovering from this crisis, and then continuing to do so in the long term by guiding their policy as much as they wish to do so. I think it's for these reasons that we win from CO. Thank you.
We thank you all. Please go outside and virtually shake hands. We're going to stay in the room. So please don't leave the room. Judges will be allocated to another room. Okay. Hello. I'm not sure if everyone here. So I see OG, I see OO, I see CO, and do I see CG? Yes, I see CG here. Hi everyone. It took us time. This had a mess and some things which are unexpected. We didn't get to a full consensus. We have one split. I'm going to reflect it. It was a very amicable split between the second and third in the debate. I'm going to give the call. I'm going to spend quite a while justifying it. If there are going to be any questions or any desire for personal feedback, feel more than free to stay here or to approach me at any point during competition. An extra part on that is the discussion was genuinely excellent with all of the panelists. I would highly recommend to approach all of them in order to achieve extra feedback. I will say one general comment before diving into why this took us time and what we've needed to sort. And the reason is, part of this debate became a highly technical question on the setout and how we understand what we are exactly regretting here. From the case of the opening government, what we hear in the beginning is that essentially the interpretation of the word after doesn't mean the immediate response to the crisis, but means something that happens immediately after the crisis. There is a question there on whether this is what we would expect from the motion. However, this is something that, due to the fact that is not challenged directly as is from the opening opposition, and even though we're a little surprised by it, we accept as the definition for the debate. And this is why this is something that may change and may surprise some of you in the initial call. However, I'm going to spend a lot of time justifying it because it changes many of the impact of the arguments that are happening. In light of that, the call is as follows. The first goes to the opening government. The second, on a 2-2 split, goes to the opening opposition. The third goes to the closing opposition. And unfortunately, the fourth goes to the closing government. I'm going to spend now time explaining the top half of the debate, how we've derived ultimately the conclusion that the case of opening government beats the case of opening opposition. Then I'm going to connect closing government and explain why they lose to both top half teams. And then I'm going to connect closing opposition to the debate and explain how the interaction of them worked, which was probably the more complicated one to outlay in the debate and what happens with it, given what I said in the initial comment. What is the case of the opening government, broadly? The case is fairly straightforward given this definition. It says, we interpret the word after as in not the immediate response to the fallout of 08, but rather when you've done processing the initial part of the process, the initial part of the crisis, do you start spiking up aggressively the interest rates to the pre-recession levels that have happened there? Empirically, this is not happening in the world. We would have preferred a world in which roughly from 2011, you start, can be gradually, but roughly start to spike up a lot of the economy back into the pre-recession level of interest. There are several parts of the case of explaining why this is something that we need to do. First, because there is going to unavoidably be another crisis, and we use this tool specifically in a time of a crisis for us to be able to deal with it. There are several reasons that are given to why a crisis is inevitably going to happen. There are also additional reasons that are explaining to us why this tool is especially efficient in a time of a crisis where you need a stimulus package, and specifically that one. That is beta. I'm not going to repeat all of these reasons, but they exist in the case. There is another part which explains why the alternatives are not going to be as useful. They explore negative interests, doing nothing, or fiscal stimulus packages. And there is another bit, which from the case of OG, that says that these banks are going to be inherently, or states as a whole, inherently not going to adapt well to long tail risks, as is apparent with the coronavirus. So even if in the short term it would have been beneficial to keep them low, they're not going to properly account for long-termist reasons. And in a combination, in this time of the short term of the economy is going to be, when it's growing, it's relatively saturated, and the value of money is lessened compared to the value of money when you're going to be striking in a crisis. What is the case of the opening opposition? Opening opposition doesn't challenge that framework of the debate, even though some of us found it a little surprising, to be honest, but this is fine. It is part of BP debating. Given that, the case of OO is, broadly speaking, there is a constant interest in keeping, and specifically in the last decade, in keeping interest rates low. There are many reasons, more than 7, I think, that are enumerated in the case, that explains to us why this is the case. You're going to have more money that is going to be in the economy. More people are going to have access to loans. More people are going to be able to build businesses. Specifically, poor workers by that are going to be hired. They're going to have more trust and confidence into the system. There are many more reasons there. I'm not going to go through each and every one of them, but essentially, even under this kind of framing, we're just willing to accept that while you're getting interest rates low, at the very least in the clash of how it's portrayed in the top half of the debate, the case of the opening opposition explained to us well that during times where there is no recession, you would have been better off. Bear in mind that the responses here of opening government are mitigatory. They explain why, ultimately at this time, you're not going to grow as much. CG later on is going to try to take this down by saying that this is going to harm the economy in the long term. There is no part of the case of OG that actually leads us there. Therefore, the comparison that is shaped in the top half of the debate is whether this is going to be significantly more useful, as in the offset of a crisis is going to be that much higher compared to peacetime economic growth, let's call it like that, for when you're not in an economic bust, you're part of the boom cycle, and how they're going to play out. The problem that we find, and the reason that is actually fairly close in the top half, is that what happens here is the alternative mechanisms that are set up by opening government and then rebutted by opening opposition are essentially a collection of one-liners from both sides. Opening government says that you cannot have negative interest rates because they give us a reason, but then opening opposition says, aha, Japan. Opening government says, but you cannot have fiscal stimulus packages because it takes time, and opening opposition says, but aha, now Trump did it, and this is just challenges which remains on a relatively low question. So we are willing to accept that maybe some alternatives are going to be feasible, maybe they're going to be delayed. To be fair, there's not much work that is done there, but even if the alternatives are going to be less resistant, seems like both sides concede to be a powerful tool, and as an outcome, you would probably want it. So even to a degree alternatives exist, it's unclear why you would want to roll out this one. There is not enough work that says why the alternatives are superior, or why you wouldn't want this in your tool shed, given this is fairly strong. The second bit is, however, how much analysis we actually get from opening government's case on showing us that you're going to not have as much value in peacetime economics compared to how much opening opposition is able to tackle that. Because we are willing to accept that during the boom time of the cycle, you are going to go faster under the case of the opening opposition. The only question then becomes in top half on how to compare these two teams, which you don't give us an easy job to do, is to try to understand on whether the offset of a crisis is going to be that much greater than the extra growth that you're going to pick up by maintaining the status quo in the times in between. Ultimately, there are 4 structured reasons that are given from opening government's second speech that are not dealt with enough in the case of opening opposition on why that are leading us to believe that the value in this time is lower. It is combined with two other things from the case of opening government. One, the fact that there is a concession that you heavily need this in a time of a crisis. The entire case of OG and a part of the case of OO depends on that. And two, the fact that the governments are not going to do a good job at factoring this in because, even if there is going to be a short-term value, they're actually not seeing the full side, unlike what OO is trying to claim. Both teams, and the way to, that would have convinced us to flip this call, if OO just would have shown us that the amount of growth that you would have picked up in this time would have been high enough that even if you're going to get hit harder by a crisis, it is worth it. This part of the case is missing. And therefore, and just in terms of like the sheer amount of opportunities, who gets them, and what happens in time for crisis, opening government beats out opening opposition. Is the top half comparison clear before I start to get into CG? So, can I also just get a confirmation that you understand what happened so far?
Yes.
Okay, closing government. There are two bits of the case of the closing government, which I'm going to compare directly to opening opposition. And as an outcome, you're going to see why you lose the opening opposition and also by the law of transitivity to opening government. What are the challenges that we get from opening government? So I think the strategic setup of the case is well, in the sense that it says we want to have the extra stability that is happening in the economy in the meantime. There are two impacts that are given on that. One is just like general stability, and the other is an outlook of developing nations and how they look like. A general comment on developing nations. We don't find it particularly persuasive that you are able to do enough work though to actually show us that all of the negative harms on developing nations are actually going to accrue to a large extent in the way that you set up your case. There are many different damages there about if you're going to hit a crisis and what's going to happen, and you're going to have doctors and nurses which are going to leave you because the economies are going to be out of sync, which we all think are potentially high impact and valuable points in the debate. However, they're not actually shown as specifically low interest and how the mechanisms are going to play out for us to believe that this is something which is going to happen to a large extent. And the key to that is to a large extent, because that's not to say that in a binary way, we do not accept that this is like something that can happen, that developing countries may be harmed by the policy, but it is not automated that we believe that this is the more impactful part of the debate, especially also because there are damages to developing countries that are derivatives of the case of the opening of both openings because they affect the entire global economy. And we just would have needed more work there in order to be persuaded that these both happen, and they happen to a large extent to convince us that the mechanisms that you provide on the second point of your extension are unique enough and strong. On the other bit of the case of opening government on stability, there you do the vast majority of the work, and we find this area interesting, and potentially, if you would have brought it stronger, could have been debate winning, which says, if you keep the economy in a position of constantly doing that, you're going to cause people to overloan money beyond their current capacity because they don't have incentive to save. This disproportionately affects a part of the economy, which makes the entire system less stable. And as an outcome can lead you to more crises or can lead people to more poverty or push them because you're going to change the incentive structure of the system for the worst. There are two issues though. One, is there is a lack of responsiveness to a lot of the benefits that are coming from the opening opposition on the values that are going to be part of a system in which people are spending more, because even if you're going to have less savings and less cushion, if you have more job opportunities, there is a degree of an offset there, which you do need to deal with like the 7 different reasons that are given from the opening opposition. The second issue is going to come very close when, from the case of closing opposition, when they're going to challenge that notion of both developing countries and the stability of the system, when they're going to claim very justifiably that it may take significantly longer for the economy to recover. If you've already been relatively hit hard by the economic recession, ultimately, by you already in a position that you need to have more debt that is going to be aligned to you. If you don't need to take it, you won't, because you know that you cannot. If you do need to take it, you don't want higher interests that are going to be attached to it. And as an outcome, by having this kind of policy, you're actually harming your ability to gain money as the person who is in the lowest part of the economic chain. So you're actually going to be hit harder. Obviously, this is a contribution from CO, so it cannot directly take place into effect on what's happening in top half. However, here, it is something which matters, because in order to value the degree of the contribution of this extension, you would have needed to be convinced that this specific mechanism actually helps people, in order that the stability actually helps them and doesn't push them into poverty. And because this is not a generic question on whether we want to have an economy which over time pushes you to borrow more money, but a question that happens immediately after a recovery from a specific crisis, the responses here are strong enough to make us believe that this is not a usual time and would have needed to be dealt with more for us to find the point more persuasive, also in the way that it engages with themes that are happening even before you, simply because this challenge exists, limits the capacity of the case, and therefore also plays out in this comparison. There is another bit, which is the efficiency of the economy, which is a second part of the first point, which ultimately won't big companies to fail for people to go to stronger ones. What we also don't get here is A, the context of why this is true by the challenge of CO in a specific context that is happening in a post-recession time, but B, and maybe more importantly, the extent also lacks here. How much more efficient the economy is actually going to be if you would have spiked up the interest rates. This is unclear how much it is harmed actually by the fact that people have some access to cheap loans. This is not to say that he could not have made the point, but this is to say that ultimately the amount of analysis and the level of acceptance that we get to the point as they were brought up ultimately fall short. And now comparing all of this with all of these caveats to the case from OO that simply says and gives us many different reasons on why cheap money is good to provide opportunities specifically to people that need it in a time of crisis and generally, is something that we accept from the case of the opening opposition. Is that clear on why CG loses to OO? Okay, OO clear as well?
Yes.
Okay, cool. Yeah, so I'm just asking because, you know, this is Zoom is challenging for our format and it's not, so I just want to make sure that people are tracking what I'm saying. Closing opposition. We, in a way, feel your pain and, you know, already see it from the POI, and it's important for us to, you know, to stress that this is, we spend a long time and just trying to understand, you know, how you shape up into the debate as an outcome of it. There is something to consider here. OG is storming out of the gate saying that the interpretation of the word after does not mean immediately as the response of the crisis, but essentially after the crisis. If you actually return to how the motion is spelled from what we get is like the regrets the trend of central banks setting extremely low interest rates after the 2008 financial crisis. So they are saying the interpretation that they give us is that immediately during the crisis is fine, and they read the word after as after the crisis is over. It is weird. That's not what we expected in the debate. The issue is opening opposition does not challenge that. And given that there is no challenge there, given that they actually offer you a second POI, they explicitly ask for you in a second POI in the DPM for you to have an opportunity, and because you do flash some of it in there, we are ultimately willing to accept that this is how the debate is set in the context of what's happening here. This is point A. Why does this matter? Because let's say even that we would not have accepted it, in the first bit of PM, what we get is an explanation on why you need this in a time of a crisis. Bear in mind that given this is the positioning that OG placed, the first part of the extension is ultimately one which is not in contention in the debate anymore. They accept it. They actually agree with you that in a time of a crisis, this is something which is necessary. What does the actual clash become in the long diagonal, and also within you and the other bits of the debate, is whether in the post time of the crisis, they say specifically 2011, it can be 2014, you know, there is like in the spectrum there, empirically you're correct that some banks in the world started to, you know, to bring up interest rates back again. They are just also giving you a POI that it's not to the pre-recession level, it's kind of the economy developed enough, developed back into the state that it had before. The question there is it fair to say that the reason that they have not done so is one in which there was actually a crucial need for them to continue? What you are giving us, which we find particularly strong there, are three reasons as to likely why this is something that might have led to us, might have been a necessity at the time. Namely, this is a tool to specifically incentivize the rich to invest money. It can be something which helps some countries to devalue their own currencies. And it takes a long time for it to build the confidence again. And as an outcome, if they've kept them low, they have good planning and they would have known that this is something which is necessary because otherwise the economy would have slided back into a full recession. The issue is that we actually would have needed more there to be persuaded that a higher spike, like what, and the clash becomes on the level of graduality between you and the opening government, that a higher spike would have actually been likely to lead the economy back into a position which is much, much worse off, because bear in mind, to the part of your case that tries to argue that, in front of opening government and the setup in the top half of the debate, that ultimately the level of that ultimately the level of the reason countries are not doing it because the central banks know doesn't deal with a point from opening government that says that they are fall short because they are bad at estimating when the next crisis is going to hit because of multiple of reasons. And as an outcome, even if you would have paid the short-term price of causing some problems into the economy, it would have been worthwhile because we would have had a significantly stronger tool that would have been in our tool package when the next crisis would have come. So essentially, also very similarly to the structure that happens between opening government and opening opposition, when evaluating your contributions, we are willing to accept that people have been worse off, specifically because of the mechanism that you portray in the case of closing opposition in the time after the crisis. If it would have been less gradual and countries would have spiked up back the interest rates to the pre-recession levels, we're just not sure the extent of the damage that it would have done. The question on whether it actually would have collapsed back the economy into a time of into a very problematic state again. And as an outcome, we would have needed a direct comparison because you come later in the debate between you and opening government on why the damage that that would have done to the economy or specific parts of it outweigh the advantages of having this tool being more accessible now, for example, at the time of another crisis, of another economic crisis of Corona, or any other one that would have come after it. This is something that if it would have been dealt directly, and we do think that you have the mechanisms there, they're just not as well developed as ideally you would have wanted them, and comparative to the benefits of the case of the opening government, how they set it up, in order for us to be persuaded that this is something that overweighs the advantages as play out in the setup of the debate. So that's the comparison between OG and CO. Is that clear what happens here? Okay, between CO and OO, here we also spend a lot of time because there is a question here. We think that CO does a more targeted job at focusing the debate, an area that matters quite a lot, which is what would have happened after, the reasons on why these countries didn't strike them back, and also just say you need time to claim the confidence. You're hitting the people who need the loans harder, etc. The case of OO is broader. It just says this is something which we systematically want because it gives more people fresh, just access into cheap capital. It pushes the economy constantly into a growth mode, and the people who are going to gain access to it are constantly the people who are just worse off. It's a more generic case, but just bear in mind, specificity on its own is not something that we rate. It's a question of the specific arguments, more focused ones tend to be easier to prove, but broader cases can, in theory, also beat more dedicated ones. You force us into another complicated comparison. And here is why we split. And to be fair, I think, just to reflect the panel, it's a very amicable one. Some members of the panel thought that the combination of all of these mechanisms that were just a little bit going stronger after the positioning and the debate of what happens in opening government tend to have a greater value on both what they're able to achieve in the impacts of the real world and how we saw the debate, and also like in how the debate was set up technically. Some other members of the panel thought that you had two things which are short there. One, you didn't show us enough on why they're actually going to slide us back into a worse situation. And two, you didn't do a direct comparison between yourself and opening opposition, but just give us, again, a couple of systematic reasons to believe and to ultimately be convinced that this is a tool that is useful pretty much all of the time because it just causes more economic growth. We would have wanted an explanation of why a slide back to an economy would have been more costly or would have been more harmful to specific people rather than the extra opportunities that are part of a long package of low interest that are ingrained in the case of opening opposition. Ultimately, the lack of the direct comparison, the fact that you come after them in the debate, and the fact that unfortunately, because of the setup, part of the case that you've done is something that we can credit quite to a limited extent because opening government concedes them. So, we can't, they're just not in contention. We view the contributions as lesser, even though to be clear, not by much and in a split between you guys and the opening opposition. Is that clear? Are there any questions there between the OO and CO comparison? OO, is that clear as well?
Clear.
Yeah, so sorry for asking again, I just want to make sure that everyone sets it out. Between closing opposition and closing government, why ultimately we believe that closing opposition beats closing government. There are challenges which are strong that are coming from closing opposition to the case of the closing government as the way that it is set up. Mainly on the question of developing countries, we're just ultimately convinced the material that I've mentioned before from closing government is built in a stronger way compared to what we hear on the topic from closing, from closing position is stronger from what we hear on closing government. Secondly, but matters more, in the time, so the vast majority of the case of closing government is based upon the idea that you need stability and you don't want people to overborrow, and specifically the weakest people in, to use your words, the weakest people in society, you don't want to push them into a situation of them overaccruing debt. There are two responses here, which are strong from the case of closing opposition that would have needed a stronger dealing with at whip. Firstly, the fact that these people probably know that they shouldn't take extra loans in this time because this debate happens after a crisis, so they would not be incentivized to overborrow. And if they do need to overborrow because they are already in debt, probably pushing them into a situation where it is both harder for them, but also they would have needed to pay much more into the future is harmful. So if in this specific focus area, what we would have needed is not a general explanation of the economy, but because both of you frame this bit as a very crucial one in both member speeches, we are just convinced that the mechanisms that this is going to flush out to people are going to be stronger. This is also coupled with another bit that closing opposition does, which to explain to us that this actually pushes the vast majority of the people who are going to participate in extra spending as an outcome of this policy is the rich rather than the poor. So a lot of the damages don't actually happen there. We do accept that there is a separate part of economic efficiency from the case of closing government, which closing opposition does not handle. However, still, we just don't think that closing government are able to show it to enough extent for it to actually become significant and overwinning the other questions as they played out. Is it clear on why closing opposition beats closing government?
Yeah, that was clear.
Are there any questions on what happened in debate? I actually, 1 second, I just please invite you to ask both myself and the panel. It took us time. We needed to sort everything that happened. There were some technicalities here. I highly invite you to talk with me or the panel at any point, but yeah, go ahead. OG, you had a question?
Yes, so both Samuel and I, when we read the motion, had the same intuition that the case we ran would be sort of the expected and intuitive case. So we want to know what other teams, and especially also the panel, since you said multiple times it was unexpected, would have thought that the case was.
Okay, so just to clarify, unexpected doesn't mean bad, it just means unexpected. The intuition that I think that most people had as the intuitive one was that this is like the immediate tool that you're going to use as an outcome of the crisis. I think that you just read, your parsing of the word after just meant when dealing with the crisis was over. I think this is fair, and ultimately, as is apparent by the call, everything that was explained and the ranking, we are ultimately fine with it. So again, just to clarify, I'm not trying to hammer you down for it. Like, this is just not what we thought the debate is going to do. But myself and the other members of the panel did not think that this is what's going to happen. That's, again, not a negative normative value here. It's just like a fact. Yes.
Okay, I just wanted to ask you, where can we contact you and other panelists for additional feedback? Is it to keep Discord?
So we can say here now, we can ask the live stream to be off, and I'm just happy to sit back and give extra feedback now. You can also try to make contact on Discord, on Facebook.
Okay, but we just have to go and grab a lunch. I'm so sorry. Is it okay? Okay? Thank you so much. Okay, for others, do you prefer Discord or?